Hello, everybody. Hello, and welcome once again to Private Equity Rundown. This is the weekly live stream where we talk about private equity and just sort of general higher level business type stuff, I guess. Thank you for joining me. This is also a live Q&A type thing. I will answer your questions as best as I can, and if it's related to the topic. The name of this episode is Due Diligence, as I understand. Yes. Due Diligence. This is episode number 10. Now, what we were doing, we started last week, was we're going through the private equity process, and there are 7 major steps in this process of doing private equity. And for those that are just joining us, that's when you buy a company and essentially flip it. You know, the idea is that you're going to improve it, but a lot of times, unfortunately, it turns out it's like a flip. Okay. But I don't advocate for that. I advocate for actually improving the business and making sure that it's in healthy shape, because that will ultimately lead you to success. So we started off with this 7-step process last week. The first step was target identification. So we covered that last week. Today we're doing due diligence. Okay, and just so everybody knows where this is going, the next steps are valuation. So what you do with due diligence will lead you to be able to place a value on the company. Okay. Knowing this, you then go to the next stage, which is negotiation, right? Where you negotiate a deal to acquire it. You then acquire it. You then do post-acquisition improvements, where you improve the business over usually a few years. And then finally, you sell it, you exit the process, and presumably have a return on your investment. So that's the process. So we're in step 2 today, due diligence. So let's dive into what due diligence is. I see there's 8 people. Thank you for joining me today. You guys are awesome. And as always, a special shout out goes out to my YouTube channel members. Membership has its privileges. And my Patreons and my super thanks donors, and obviously to all you guys, my participants. Thank you for being here. Always a reminder, if you are looking to learn more about business and you would like to do that with me, check out that course. That's the best bang for the buck around to learn business. So you can, hold your own when it comes to this issue. You can step into this world. And a lot of these principles, I believe, and I found that a lot of them you can apply in your career in various capacities. So that's why it's not just something that you would do if you're in private equity, but if you were wanting to climb the ladder into management or be an entrepreneur or anything like that, a lot of these, knowing this stuff really can open up possibilities for you. And, a lot of good things will happen once you know how stuff works in the world of business. After all, business is the scientific study of how to make money. So, let's dive in. Due diligence. Okay. So what is due diligence? Due diligence in this case, and in a general sense, is diving deep into the target company that you're going to buy and just verifying that everything is above board and as it appears. Okay. And understanding what's really going on. Okay. So you're going to be verifying that everything is in its place and they haven't lied, they haven't tried to hide things. The business is as healthy as it's supposed to be, or as you think it is. Okay. And all of this, of course, is to be able to place an accurate value on the firm, on the targeted firm. That's the whole point of this. So there's no surprises. You know exactly what you're getting, and it's a fair price for what you're buying. Okay. So you're going to be looking for anything that will impact or affect the investment. So if you buy this firm, anything that could affect its value or how things go is going to be of relevance to you. So to give you an idea, there's several sort of areas here. You're going to be looking at the financials, obviously. Okay, you're going to be verifying all of that. That's what due diligence is, where you verify things. You're going to be looking at all the legal documents, okay, all the contracts the company has. You're going to be verifying all of that stuff. You're going to be looking at their operations, their actual business processes and what they do. You're going to be verifying all of that what they have been doing is what they say they've been doing, and so on. You're going to be looking at key things like customer contracts, making sure that what they're purporting to be the case is obviously the case. You're going to be looking for employee issues. Employees are the people that are able that run the business. So these people need to not be on the verge of leaving. They need to not be dysfunctional. They need to not be lying about things, and so on, right? And you're going to be looking for, in general, you're going to be looking for any potential risks. So to do with this stuff and outside of this, okay? That's the whole point of this process. That's what it is. Now, the general partners in the private equity firm oversee this process, okay? They have ultimate responsibility. So they're the ones that are going to be, at the end of the day, managing it and taking responsibility for it. Now, what they're going to do is they're going to be assembling a team of accountants and lawyers, and my thing keeps jumping on me here. Here we go. And consultants. So you're going to be putting together a due diligence team that's going to be able to go into the business and be able to essentially audit all of these various aspects of the business. Okay. So you're going to need lawyers to go and look at all the legal stuff, accountants to go in and audit all the accounting stuff. You're going to need consultants, presumably people that are have deep industry knowledge and experience to go in and analyze the processes. Okay, you're going to be interviewing lots of people. Okay, so you're going to be looking at documentation. You're going to be interviewing people, and sometimes they do observation too to see, if what's going on is indeed what is supposed to be going on. This process takes a matter of weeks up to several months, depending on what we're talking about. Okay, so it's a lengthy process. It takes quite a bit of time to do this. And it begins with the private equity firm sending a document to the target firm. And that's called the due diligence request list. So it's basically saying, we are going to be requesting all of this stuff from you. Okay. And then the company complies with all this stuff, right? Now, what I think is interesting about this process is examining a lot of the common pitfalls, the common dirt that's raked up by this process when people go in and they audit a company and they see what's actually going on. Some common, it turns out there's a list of sort of common things that are well known that people specifically look for. Okay, you can look at it like this. So, for example, to start off with sort of the financial side of things, okay, common issues are finding hidden debts. Okay, so where they disclose the financial statements and it turns out that, maybe there's more debt than what the company disclosed, something like that. Obviously, that would affect the valuation of the company. Tax issues. If it turns out the company hasn't paid taxes for the last 10 years, that's obviously going to be an issue. That's going to be a tremendous liability. So being able to investigate that, make sure their taxes are all done properly and all this, that's obviously, something that the accounting team would look for. Any kind of, like I mentioned debt, but any kind of off-balance sheet liability, basically. So something that hasn't been disclosed that's an obligation for the company, financially speaking. So, you could have debts, things like pensions, it's a debt where the company's paying it out. But I'm not an accountant, but I know that there's some special treatment for how you handle things like pensions. So because of how it could be obfuscated, you would want to check for those things, make sure that they're not kind of hidden and you understand what you're getting into. Any kind of liability is not listed. That could involve leases, even things like joint ventures. If you're you have some kind of joint venture set up between this company and another company, it might be handled different financially because it's allocated to that joint venture. So once again, I'm not an accountant, but I do know that they can sort of isolate the accounting of the joint venture from the accounting of the target firm itself. And you can run into issues like that. So that's why you need like an accounting audit team to really go in and really search and dig and, find out what's actually been going on. Any other type of unrecorded liabilities, not that it's not, it might not be outstanding debt at the moment, but, maybe a recurring payment that was settled in the past, but it's recurring, so it's going to come up again. All this kind of shenanigans, right? Really. You might find other things that are kind of pseudo-financial, like, key assets that you just assumed were owned outright. It turns out they're leased, things like this. So these are kind of some unpleasant surprises that private equity firms find when they come in and investigate a target as part of the due diligence process. There's all kinds of weird things on there. Like they could be promised earnouts to managers, things like this, or the owners. Like it's a sort of, like an undisclosed earnout promise made to the owners, something like that. These are all things that can come up. Okay, if people have sort of not declared them or not mentioned them, they can obviously affect the value of the company. Now, that's kind of the accounting side, like, stuff in the past that might lead to current issues. There's also stuff in the future. Like, for example, if your projections are off, your financial projections are overly optimistic or something, that's still part of the accounting package in a way, but it sort of veers away into other areas like operations and stuff. The company might be doing things to hide deteriorating margins. Like, for example, maybe they're playing games with the timing of receiving payments and things like this, right? They're not sort of booking things when they're supposed to. They're booking things in advance, or they're altering their conventions for how they, tabulate transactions and things like this. There's a bunch of stuff in there. It can contribute to your financials being essentially out of whack. You're going off the numbers, but you're not taking the timing of payments into account, and they're playing games with that stuff. I think that's probably, a lot of the key financial type stuff. Now, in other areas, things like operations, as you can imagine, there could be a whole kaleidoscope of different issues that you would have to look for and you could discover. For example, they could be masking how dependent they are on key staff, right? So you have just a handful of key employees that, they're running the show. They contain all the knowledge of like how to run the business. So if they were to leave, it would be extremely disruptive. Things like that. Maybe, the reason why you have key customers at that firm is because of one or two employees. And should those employees leave, they would take all that goodwill with them. They would take those customers with them. Things like this. Very important to know this, to really understand that. In certain industries, you have the goodwill following the person as opposed to the goodwill tied to the company, right? Construction, the construction industry is very, very much like that. Someone could sell their construction business, but it almost doesn't make sense because if they leave and go to a different company, they take all their customers with them, right? And their reputation with them. So, you want to be aware of that stuff if that's the case. Let's see. I'm trying to read, just so you know, I'm trying to read my very poorly written notes here. I really need to get better at this. There are some people that know shorthand, and, it's pretty impressive. I think it's a lost art, where they can just write down what somebody says in real time and then read it back. Just amazing skill, something that's been lost. I know you've got like, speech to text capabilities now, but it's not the same. If you're writing down notes and you do like a speech to text thing, we're still at the stage where you get this big block of like undecipherable, rambling things with ums and ahs, and it's very hard to turn that into usable notes. Anyway. Okay, so we talked about deteriorating margins. They could be dependent on key staff. You could also be dependent on key customers. If 80% of the business the company does is with one customer, you really need to know that. That's like a huge liability. If you lose that customer, the company's done, So things like this are very, very important to know, so you know exactly what you're getting into. Maybe the company has weak customer retention. They drum up business, but they treat their customers like crap. So a lot of customers don't return. Maybe when they should. Maybe in that industry, normally customers would return, but with this company, they don't because they have such a bad experience. Things like that. Obviously, that's a huge liability. You'd want to realize that, if you're about to buy it. There's all kinds of stuff. Like on the supply side, you have all kinds of inventory stuff that could be going on. They could be playing all kinds of shenanigans with the books with regard to inventory. But legally, you might have contracts with suppliers, and maybe those contracts are, they're not what they appear to be. Maybe they're unrenewable. So right now you're getting a good deal, but unbeknownst to the new owners, that contract is going to run out in 2 months. And after that, the cost of those materials or that supplier will double or something. You know what I mean? So you would have to know things like this. You have to really get into the nitty-gritty. And these are all things that companies have kind of pulled shenanigans with. They haven't disclosed this, and it's had to have been discovered through the due diligence process. And then it's led to major changes in valuation. It's led to the deal falling through, things like this. What else do we have? On the legal side, you could have things like pending lawsuits. Whoops, I forgot to mention, we're being sued for $100 million by this plaintiff that has a very strong case. A former employee, they know all our internal stuff, and they've got a strong case, and we're due in court next month. Obviously very important to know things like this, right? Whoops, I forgot to mention that during our entire dialogue about this potential deal. So that's where you have to have like lawyers and stuff on your team to be able to go and investigate all of that stuff, all the possible things there could be in the background. What else could there be? Did we already talk about it? Inflated growth projections. Things like this. Very, very big, very common thing there. Anybody can make projections for anything, really, based on some kind of logical argument. Is it accurate? Now, how would an accountant or a lawyer know? You wouldn't. The only way to detect things like that would be to have an industry expert on your team, someone who's familiar with the industry in depth, and they would intuitively understand like a lot of the margins and a lot of the ratios. And if something kind of looked out of whack, they'd be able to not only know where to look to verify things, but also they would presumably be familiar with every trick in the book to be able to fudge things and obfuscate things and not disclose things. So that shows the criticality of having like real industry expertise on your team when you're doing due diligence. It's almost impossible to do this properly without it. Excuse me. Things like IP disputes, intellectual property. You could have like, it's not actually a lawsuit yet, but you could have what's leading up to a lawsuit. You could have disgruntled people that have claims to various things. And, in the past, the company might have been behaving in a very brazen, risky way by liberally taking other things from other places. And just because you're not being sued now doesn't mean that you don't have a bunch of legal liabilities on your hands that you're inheriting if you were to buy the company. Now, they also look at the workforce. Like, Okay. Thank you for telling me that. Oh, God. That's wonderful. So I did all that talking for nothing. Thank you for at least telling me that my microphone was out. This is, I think, the last straw for me with this this setup I got here. That happened to me, I think, a month ago, where I was doing a live stream and it kind of went out. Anyway, I don't suppose anybody could tell me what's the last thing you heard. If you can, I'd appreciate that while I try and fiddle with this thing. Okay, that seems to work. Check, check, check. There we go. Okay. Anyway, there are still 13 people here, so hopefully it can't have been that long since my sound was out. Anyway, I was covering sort of common pitfalls in due diligence, things that you find or commonly found that are issues. As I said, if someone could tell me what's the last thing you heard me say that I know where to continue from, if you could please do that. If anyone knows, I'd appreciate that. I'll continue from there. Anyway, what I was talking about is I was going through a sort of laundry list of common pitfalls in doing this stuff and what people find during the due diligence process. And I covered a lot of different things here, so I don't know how much you guys heard of that. But we talked about a lot of financial stuff. Okay, there's like several financial things. Tax issues, hidden debts, off-balance sheet obligations like leases, joint ventures, debts like pensions, unrecorded liabilities, key assets might be leased, undisclosed earn-out promises made to owners, and then pseudo-financial stuff like financial projections. Okay, whoa, that's an interesting handle. Zyogxalistic says, last thing was looking at workforce, I think. Okay, excellent. Thank you. Thank you, Zio. That's very helpful. It's nice when people can help me out there for my failings. I told you guys this year I'm going to upgrade all my computer setup, audio visual stuff, because I'm using stuff that I had before I had a YouTube channel. I've used the same computer and the same microphone and all this kind of stuff since before I even had a YouTube channel. So I'm going to actually upgrade it this year. Okay, so workforce stuff, where we left off. Critical employees planning to leave. Okay, beyond the workforce, I was talking about compliance and things like safety. If the company's been violating safety rules for a long time, big liabilities. If it's been violating environmental rules, that's a big one. Now, what I was saying earlier was I previously was the head of safety and environmental for a company, and in my experience, environmental is like a really weird area because it's the only area that I've come into contact with where there's no grandfather rule. What that means is that let's say you bought a building, okay, like some industrial facility, okay, like just like a shop space or something like that, or a warehouse or something like that. And that building has been around since, say, the 1970s, right? But you're buying it now. And it turns out that unbeknownst to you, back in the 1970s, a previous owner spilled a bunch of oil or antifreeze or something into the ground on that property, okay? Now, at the time, it wasn't actually violating any of the environmental rules at the time. But since the 1970s, when this happened, they've changed the environmental rules. They've sort of become more stringent. They've raised the bar. And now it's illegal to dump a whole bunch of oil and antifreeze into the ground and have it soak into the ground. Now, the problem is, so you buy the property, okay? Now, unbeknownst to you, the ground contains a bunch of oil and antifreeze. You didn't put it there. You've actually been really good at following the current environmental rules, right? The problem is that if you now own that property and there's an environmental audit done, which has to happen every once in a while, and they find a bunch of antifreeze and oil in the ground, the current law says, not only is it illegal to spill it into the ground, you can't leave it there. You must clean it up. If you own the property, you have to clean up the property. So even though you didn't put it there, all of a sudden now you've got to clean up the entire property. And there's no grandfather rule that says, well, it was legal when they did this. It's like, no. What matters is it's illegal now for that to be in the ground. So sorry, you got to clean it up. So this is a huge liability, as you can imagine. And it kind of, in a sense, it punishes the current owner for something maybe a previous owner did, right? So as you can appreciate, stuff like this is a big deal, and it's hard to detect. That's the thing. If you find that this firm hasn't had like an environmental audit or whatever for a long time or forever, maybe they didn't need one until now or something, big liability. So there's all kinds of stuff like this you got to be aware of. Now, let's kind of wrap this up. How do you find this stuff? I listed a whole bunch of sort of miscellaneous shenanigans and problems that one could find during a due diligence process. How would you find a lot of these things? Some of them seem pretty straightforward. You send in a team of accountants, they do an audit, and then bam, they find stuff. It doesn't seem like that hard. But some other ones are pretty damn hard to find. Especially things like employees fixing to leave, key employees fixing to leave. Who documents the fact that they're like thinking of leaving, right? How do you detect that? If you interview them, they won't disclose it, but they have every intention of leaving as soon as they can. How would you find that? Very interesting stuff. So here's kind of the due diligence process, at least as I know it. First of all, you do thorough document reviews. Okay, so you send in this team of due diligence people. They review all the documents. Okay, they dive into every process that the firm does. Okay, and they try and understand it on a very granular level. So as you can appreciate, that's very time consuming. You got to get into every little detail of what they do. You got to ask a ton of questions, imagine a ton of scenarios. They interview management. They interview the employees. They interview former employees. Then they go outside of the company. They interview your customers. They interview your competitors. They interview industry experts. People that know all the little tricks, right? That's why, incidentally, you need like in-depth industry knowledge to do this. If people want to hide things, they can, and they're at an advantage if you don't really know the business very well. Accountants won't know the business. Lawyers won't know the business. You need operations and marketing people like that really, really know the business, on your team. You know what I'm saying? So there's a lot of that stuff where you do like all kinds of research. You go outside and inside. So very, very in-depth process. You need a team of people to do this. It takes them a long time, and they dive into everything. Now, imagine for a second the cost of doing this. It's a substantial cost. Highly talented, high-paid people, a lot of them spending weeks and weeks and weeks to months on it. Not cheap. So you got to take that into account. Okay, so that's where I'm probably going to leave it right here. We are going to continue next week with the end result of this process, which is valuation. Like now that you know all this stuff and you've revealed everything that's going on and all the liabilities, then we're going to place a price on the target firm and talk about that. So there you go. That's due diligence, at least in as much as I'm going to get into it. If anyone has any questions, feel free to put them in the chat. I will try to answer them as best I can, and we can go from there. I'll leave that up to you guys. In the meantime, while we're waiting for any questions that anyone might have from the 13 people that are here, thank you. As I said at the very beginning of this stream, if you want to learn business and you want to do it with me, check out that course. That's the $100 MBA. You can learn everything that you would learn in a brick and mortar 2-year MBA program in a university, because you're covering the same material. You're using the same textbooks as them. You're just reading it on your own time, on your own schedule. It's very, very flexible, and you can skim topics if you want, or you can go really in depth. It's entirely up to you, based on what your goals are. And this is a highly flexible, very cheap way of learning the same material. And best bang for the buck anywhere. And I created it primarily for entrepreneurs, also for people who are interested in business. They want to use the knowledge itself to make them more effective in their current jobs, to move into management, or to learn how to make money, which is, after all, what business is. And the other class of customers that have bought this course is actually people that are wanting to do a proper MBA, in a university for a couple of years, but they want to put their toe in the water first just to see what they're getting into. What are these topics? What does it cover? Give me a feel for what we do. So this provides that too, at a tiny fraction of the cost. So check that out if that's kind of what you're looking for. I'm not getting any real questions for any of this stuff, but that's fine. Thank you to the people that let me know that my mic wasn't working. I appreciate that, before I talked for an hour not realizing that. And that was great. That was really helpful. You helped salvage this. I will be back next week at the same time with the next installment in this process. And if you have any questions about this stuff, then let me know. As always, I talk about this stuff because some of the concepts, if you know them, can be applied to your career or your situation, or give you interesting options that you might not have considered. Things like management buyouts and things like that. If you know some of this stuff, you know how this process works, there might be some interesting career possibilities for you. So I'll leave it there. Thanks, everybody. You guys are awesome. I will see you next week. I will be back in about 25 minutes. I have a regular live stream where we talk about job search. You can join me for that this afternoon. Other than that, have yourselves a great weekend and take care of yourselves. I'll see you soon.